guys, welcome back to Cash Flow Confidence. In today's episode, I want to talk about how to use your numbers to prevent burnout. I want to talk about this because I feel like we as business owners, we let our numbers lead us into burnout really quickly and we don't really realize it until we're there. So for example, especially around this time, since it's, the beginning of the year, what happens is we set targets for ourselves. I want to do, 50% revenue growth this year and I want all these things to happen. And you're going to make, maybe not consciously, but subconsciously, you're going to make all these sacrifices in your life to try to achieve what I call like vanity metrics. I call them vanity metrics because they don't really mean anything outside of themselves. So you might be like, well, I want to make $3 million this year just because it feels good to say I made $3 million. Don't do that. Instead, what I want you to do is pick your numbers, your targets, such that they support your life. You don't have to sacrifice your life in order to achieve these. And so the first thing is when you are thinking about revenue targets, like I said, you might just have some arbitrary number in mind because it feels good to say it. Instead, I want you to think about what your revenue per employee is, especially your gross profit per employee and your gross profit per product line is. If you don't know these things, you need to figure them out. The quick way to do so is figure out, okay, I've got X person working on these jobs. I charge this amount for these jobs and their salary is this. That difference is the gross margin per employee. That's what you need to focus on, because if your gross margin is super, super thin, so that means like whatever you're bringing in, most of it's going out, revenue is not going to fix your problem. It's going to make it worse. So you bring in more revenue and you're not going to keep any of it. You're just going to be working a lot harder. So what you need to know is, what is my margin per employee? What is my margin per product line? Now, I'm going to get into kind of an accountant speak for a minute, but it's very important to know this because your whole business success is going to fall after this. So I just told you how to calculate your revenue per employee. To know your revenue per product line, say you've got like 4 different things you offer. They either do or don't cost materials depending on what your line of business is and what it is you're offering. But if you do something that requires a degree of like manufacturing or selling a thing, you need to know, obviously, what the materials it costs to sell that thing is, and you need to know how much you are spending in labor to sell those things. That is your margin. And so if those are in a healthy spot, now you can say, okay, well, I really want to ramp up revenue. And, if I'm doing $1 million this year, what's it going to take to do $3 million this year? It's also going to give you a degree of knowing what kind of capacity you have, because let's say you have team members who their gross margin is just insanely huge. That's probably somewhere where you're like, okay, well, now I can afford to give this person a raise because they're bringing in like 4 or 5x what I'm paying them. And then you'll know that you have team members that are only bringing in like 2x what you're paying them. And in that case, it's like, okay, well, somebody's trying to burn up the clock here, So beyond tracking revenue or profit per employee, it's very important you track your margin per product line, because this is going to tell you who are my most profitable clients versus who are my, break even just about clients. And beyond who's easier and not so easy to work with, I'd be willing to bet that the clients for you that have the biggest gross margin are the easiest ones to work with. And those ones that you're not even really keeping anything off of them are those ones that are super pesky and needy and just need to go. So tracking your profit per product line is going to tell you this information, because you're going to see, okay, well, I know that customers A, B, and C are my most profitable. So when we are going out and marketing to more customers, let's keep their profiles in mind so that we sign on more like them. Whereas customers X, Y, and Z are our least profitable. Let's figure out what characteristics those have, what kind of offers we're selling to them, and let's sell less of those things so that we keep more of what we're bringing in. Another thing is, I want you to calculate what your own personal minimum pay is, and do that by backing into what you want your lifestyle to be as far as how many days a week you want to work, what your bill payments are that you need, and then how much, disposable income you want to have. Use those factors to figure out what it is that you need to pay yourself and make that non-negotiable, because I see all the time where business owners have all different things flying at the business and they will put their own pay way on the back burner. All that does is make you hate your business. So don't do that. Your salary is non-negotiable, just like your employees is. If you were having a bad business month, would you go to one of your employees and say, the jig is up, like I can't pay you this month, sorry, and expect them to stick around? Absolutely not. So don't do that to yourself either, because we didn't create businesses so that it could just completely take over our lives. Just like if you were working, a 9 to 5 and your boss was having cash flow issues, would you expect them to tell you that they can't pay you this week? Absolutely not. So we talked about gross margin per employee. We talked about gross margin per product line. And we talked about making your own salary non-negotiable. I want to talk now about kind of the last thing in there, which is all of the rest of your overhead. So once you have figured these things out, now you have room to figure out what my true overhead is. So you've got your owner salary. Let's say you want to do 20% net profit this year. Back that out of your expected revenue. Whatever is left is what you have for overhead. Now, overhead is not something that you can really afford to be like, well, let's say my overhead goal is 30% of revenue, but it's been at like 50% of revenue for a while, and I think we're just going to keep it there because something else in your business is making that sacrifice for your overhead to be way more inflated than it is. And so what I want you to do, if that's the case, is go through and audit everything that you've got going out, especially when it comes to subscriptions, because those things can creep up on you. If you're paying for something and you're not using it, get rid of it. I know rent is going to be probably the biggest one there besides payroll. But beyond rent, payroll, you've got, business insurance, utilities, things like that. Go through and audit every single one. And you need to figure out, okay, if my overhead goal is 30%, what is eating into that and eating into my net profits? And if you find that you're just super lean, like there's nothing you can cut, at that point, you need to start increasing your revenue. But like I said in the beginning, don't do that until you know that you're keeping what's being brought in. So that's kind of a way to approach making sure that your business doesn't burn you out. The two biggest things are making your own salary non-negotiable and your work hours. Because believe it or not, a business owner does not have to work through dinner every single night and miss all their kids' games and things like that. That's a choice that you're making. And I know that's probably a hard pill to swallow, but when you're missing out on a bunch of things in your life, you're making that choice. It's not a requirement of you to have a successful business. That's all I have for this week. See you guys next week.